Right now, as we speak, there is a powerful technical structure forming in the market, known as a market maker cycle. This structure is by far one of the most reliable and consistent setups that I look for in my trading system. Not only because it takes advantage of the mechanics of the market or how they actually work, so it stands the test of time, but it's also really straightforward to trade and execute on. And since this setup is forming right now on SPY and SPX, I thought it'd be no better time than to explain this powerful concept. So if you've been looking for more consistent setups to add to your playbook as a trader, this is definitely the video for you. My name is Raider, and as we dive into everything about market maker cycles today, I ask just of one thing: your attention, so that you get the most value of your time here. Whether you end up agreeing with me or not on what I show you today, at least you walk away with a more formed opinion. That's the only way to become a better trader and to find what actually works for you. So let's get started. Now, before we get into how to actually trade a market maker cycle and, well, make money from it, we have to identify what even is a market maker cycle. Well, on screen now is the anatomy or construction of this powerful structure with each of its components, which we will be explaining throughout this video. This setup allows us to exploit and take advantage of the mechanics of the market, or how they actually work, which means it's much more accurate than traditional patterns and indicators. Well, because there's a reason behind the price action that will actually justify why it will continue to move. Unlike patterns and indicators where we're just hoping that the shape plays out. And the mechanic that it relies on the most is actually the options market, which I'll explain later. And believe me, whether you trade options or not, this is going to be really helpful to know. So if someone ever came up to you, I don't know why they would, but if they ask you, what is a market maker cycle? Well, you better tell them that it is a technical structure that we look for, mainly characterized by a spring in max pain that helps us better time and take advantage of the effects of the options market on the stock market. Now, it's okay, don't panic. Let that definition marinate a little bit. It'll come around to you. Oh, and if someone doesn't come up to you and ask about a market maker cycle, then just approach them anyways and tell them all about it. And hey, speaking from experience, you can thank me when you get a girlfriend because you do that. I'm kidding. So now that you have a general idea of what a market maker cycle is and why it's potentially useful to us, let's actually go to the price charts and break down the components of this structure so that we can know exactly what to look for when we're trying to find one, and of course how we would trade it. So let's break down each individual component of a market maker cycle, and the way I'm going to do that is by relating it to one of the biggest, from a P&L perspective, market maker cycles that I've traded, which was October of 2022, the bottom of the market. And right here, over to the left, we have our little graphic, and over here, we have the actual market maker cycle that played out. So starting to the left of the spring, we're going to break down each characteristic of the major components. You'll see different colored lines. They have different characteristics, which I'm going to describe. The blue line here, known as the accumulation base, is the start of a market bottom. This is often the first sign that you're nearing a bottom. You're not always going to get a market maker cycle for a market bottom, but it's the first symptom and sign that one could likely start to form. The accumulation base and bottom is often characterized by higher volume as market participants step in front of the selling. They start to buy and they say, you know what, I think this is somewhat fair value. I think this is going to be a better opportunity. I'm liking where the price of the market is. And so what you get is a lot of people starting to buy. And we can see oftentimes, not always, but oftentimes you will see an increase in volume as you did here. Common structures or shapes of this is a diagonal parallel or a trending diagonal parallel, downward sloping in the direction of the sell-off. This is often a sign that the selling pressure is slowing. People are starting to step in front, and thus you will get an increase in volume. This accumulation base is often what I refer to as the technical bottom. It's not actually the bottom, but it's where everyone buys and then they get eventually violated later, but that is the actual bottom, the max pain. So this is the technical bottom, and the actual lowest price of the market is likely always going to be the max pain or the liquidation move. We'll get to that. So at this point in time, the accumulation base, you're not going to know a market maker cycle is forming. When you can know a market maker cycle is forming is from the spring to the max pain. So moving on from the accumulation base, again, we don't know this is a market maker cycle forming yet. You can see then often what happens is you'll see a big move higher, but then a consolidation of some sort and then another drop. This consolidation and fake out is a symptom of everyone buying previously. So what happens is everyone's buying here, buying here, buying here. Then all of a sudden the market pops, but then no one starts to buy. You can see that by lower volume, but also in majority of cases, you don't even need to look at volume. You can just assume that implied volatilities are still elevated. And when implied volatilities are still elevated, we'll get to this later, don't freak out. That means that the options demand is still high. People are still hedging, and therefore this volatility is not going away. And when volatility doesn't go away, it causes a lot more selling in the market, selling pressure. And so that does not help a bottom to be alleviated, or the market to be actually relieved to actually rally. So this creates a fake out, and it traps a lot of people long in here, but ultimately it fakes out. Now, as you move from the spring to the max pain, you will then be able to identify that, okay, this is finally a market maker cycle. The key point to where often I identify the market maker cycle is the drop after the spring and back into the previous channel or box. So you can see right here, we drop back into this area. These two candles right here, I'm already assuming a market maker cycle, and I'm going to assume a new low in liquidation is about to be made. So that is where you can identify that this is truly a market maker cycle, and then that gives you that early forecasting edge, which again, we're going to talk about. But moving on to the max pain move, the max pain move, its purpose is to create a climax of selling in the market. You're going to liquidate the level where everyone bought. You're going to go below that, cause pain for those people who longed, change the sentiment. This is where you're going to see all the negative sentiment. Oh my gosh, it's over, everything's bad, the economy's collapsing, all this stuff. But also you're going to see, from a positioning standpoint, everyone hedging here. You'll often see a common characteristic of a max pain point is you see a lot of hedging. And that is reflected on the put to call ratio. But the put to call ratio is PC on TradingView. The put to call ratio, and you will be able to see, has that spiked? Is it spiked super elevated compared to previous days, etc.? That's telling you that everyone's buying puts, which again causes a rally. Now, I want to be clear about a few other things. The max pain is often 99% of the time quicker than the spring from a time perspective. What does that mean? Oftentimes the spring will take between 3 to 4 days, maybe even longer, but the max pain needs to be shorter than that. Oftentimes you'll see the best market maker cycles are 1 day max pains or 2 days max pains, where you get a drop below the low and then you get a big instant change in buying pressure or instant change in market dynamic. So the max pain is quick, it happens fast, it can happen in the after hours, and most of the time it actually does happen in the after hours because that causes more pain because people can't reposition. Again, the max pain point is to create a climax of selling in the market, cause the most pain for the buyers, but also the main goal of it is to create as little people in the market as possible. That you're hitting this point where no one wants to really sell anymore, but no one really wants to buy anymore. And that creates the path of least resistance to the upside. Now, we mentioned earlier that the point of a market maker cycle is to take advantage of the mechanics of the market. And the max pain move is really where you'll see this take effect. I don't care whether you're an options trader, a futures trader, or an equity trader. You need to understand this concept. This structure, the market maker cycle, takes advantage of a mechanic of the market, specifically the relationship from the options market to the equity market. What does that mean? And again, I don't care what you trade. Listen to this because it does impact your trading, whether you're a futures trader or equity trader. The options market is the biggest liquidity provider in the world. What does that mean? Well, in 2025, option volumes have absolutely soared. Everyone's trading options. Why does that matter? Well, someone who's trading those options is buying them from a big entity. Think, the whole world is long. Everyone's long equity, all these asset managers, everyone's long, and all they're worried about is hedging the downside. So what often happens? Well, you go out and these big funds will buy a bunch of puts to cover their downside. But who's selling them these puts? Well, it's the market makers. Now, we call this a market maker cycle for a reason. We'll get to that. So market makers, they sell the puts to the public. So we're going to write this. Market makers sells puts to the public. Now, market makers can theoretically take an infinite loss. Why is that? Well, options can have an infinite gain. If markets go from 550 on SPY all the way down to 0 in 1 day, you're going to be up millions of %, and therefore that's what we consider infinite gain. The market maker would have lost trillions of dollars. So he's going to lose a lot of money. So how does he hedge his risk? Because the market maker's job is to sell puts and options to the public. He takes on liquidity. His business as a market maker is to get as much business as possible and be neutral, right? If he can get a big book of orders and he can balance them out, then he makes a little bit on the spreads and the commissions, and so he makes a little off the top. So his business model is to be as balanced as possible. Despite the common belief among retail traders that, these entities are malicious, they're hunting your stop loss. They're not. Their goal is to remain balanced in the market, and they have incentives to remain balanced in certain actions. Now, going back to this, if they sell puts to the public, how do they remain balanced? How do they hedge their risk to the downside? Because they can take an infinite loss. Well, they're going to go out and short equity. So the options order activity actually has an effect on the underlying stock or the stock market. So if you don't understand this principle that options can move the markets, whether you trade futures, equity, whatever, you are missing out because you are trading blind. You need to know what the options market activity is because it is the biggest liquidity mover and provider in the entire market now in 2025. Because of how high the volumes and how high these levels of trading are within the options market. So because there's so many options, the effect of options is so much more drastic because the market maker shorts equity. Now, going back to the market maker cycle, how does a market maker shorting equity or selling equity when he hedges these puts matter? Well, let's go back to the max pain structure. When the max pain point is hit, when you liquidate the technical bottom, what happens is, like I mentioned earlier, you often get a spike in the put to call ratio. The put to call ratio shows how many people are hedging in the market, basically. When you see a drastic spike in the put to call ratio, this was that day on October 13th, you see it opened all the way up here at 1.37. That was the second highest reading in who knows how long, 3 years, 4 years. That tells you that for every one call in the market, there's roughly 1.4 puts being traded. And what you can infer from that is literally everyone and their mom is starting to hedge at this level. When everyone starts to buy puts, right, and they're hedging their downside, the market maker short equity. However, since no one's selling except the market maker now, you kind of get this climb up. And as you get this climb up, what happens is with everyone who is in those puts, they start to lose value. Well, when those puts start to lose value, ask this question. Does he need as many hedges if they're losing this much value? No. So as those puts start to lose value and you get less demand for those puts, then you start to get a crush of volatility. And this is what we call it, a crush of volatility, a crush of options premiums, where all of a sudden, everyone who's wanted to buy insurance or options has already bought it. And now that less people are in need of it, the pricing of the options is dropping, not only because the stock is moving against it, but also because the demand of it is decreasing in general. And also you're getting closer to expiration, right? You are going to cause the market maker to adjust his hedges of his own book. And so how does he exit a short position or where he sold equity? He buys back shares, okay? And this is the key with this structure. The reason this works so well is once we have this accumulation base, we come up into the spring, then we drop and we liquidate the low, causing pain for the people who bought over here. And then you go for that max pain move, trap everyone short, everyone's hedged. All of a sudden now, everyone has lit a fire of puts right here. Everyone has bought puts. The people who longed, a lot of them are out of the market now. So you have this rocket fuel to start going up because as it goes up, puts are going to continue to lose value. As puts continue to lose value, the market maker is going to buy back shares. And as he buys back more shares, the puts are going to lose even more value, causing him to buy more shares back. So now the trend is supported by the market maker. And this is why we call it a market maker cycle, because you can see right here, now the dips are starting to be bought. You didn't see the dips get bought here. Nowhere in this trend from this high did the dips get bought as aggressively as now. So the reason we call this a market maker cycle is it's supported by the mechanics of the market. In that a market maker who's selling options to the public, mainly puts because the world is long, when he sells these puts to the public, he's going to be short equity. But he can't move an entire $120 trillion market by himself. There's multiple market making firms, but they all do the same thing. So what happens when there's no selling and he's the only one selling? The puts are losing value. He needs to exit his hedges that he bought, and so he's going to start buying back shares. And all of these market making entities collectively are now supporting the market. Huge backings, huge equity support in that sense. So whether you understand options or not, this principle is incredibly important because options do move the markets. They are the biggest liquidity provider. And this cycle aims to take advantage of that by identifying this max pain. And then after max pain, you have the two recovery flags. And then the final part of this green line is really what we should talk about. This is where you're going to be trading a lot of the long trades, right? You're not going to be trading longs here necessarily or here. The big long trades are going to come following that liquidation to the spring high. 99% of these market maker cycles, you are almost guaranteed a move back above the spring high, at least. So you want to make that your final target or your target 2 of the market maker cycle. You can see here we had 1 flag, 2 flag, and then we came up and finally broke that spring high. So the spring high is the target, and that is, again, because of this fuel that we have of the puts supporting the trend as we go higher. Now, before I show you current day on SPY and SPX and how we can actually trade it moving forward and my game plan for it in real time, free of hindsight bias, we can look at a few other examples because market maker cycles come in all different shapes and sizes. So for example, in 2022 as well, January's top all the way down into January's bottom, here's the technical bottom. And again, remembering the characteristics of each one, technical bottoms are often diagonal parallels or rectangles characterized by higher volume, but that's not actually the bottom. What you get is everyone buying here, then you come up. Now here's your spring. Again, you might not know this is a market maker cycle yet, but once you start to see this drop back into that technical bottom, this is where you should be going, oh yes, this is a market maker cycle. Again, as you move down, you can see oftentimes the selling is characterized by lower volume. Then you go and you liquidate the low. So here's the technical bottom. Here's the spring up here. And here is the liquidation bottom. So this is the max pain move. And you can see, boom, right there. You refuse to make another low. This is the actual bottom, but this is the technical bottom. And then you have a move higher that targets the spring high at least. And you can see we just got above it and then sold off again. But it doesn't matter. The target, the final target of this structure is the spring high. Afterwards, it can go up, it can go down, but we're going to have to reassess that. But the structure itself kind of guarantees, if you will, that spring high touch if you do see one. You can see most seasonal bottoms actually end in this. Here's another example you had right here. This is your technical bottom, higher volume. You can see a little wonky with this new low here, but then you had this move here. Here's your spring down here, big move down, liquidation. Then you have your move, you get above that spring high, you start to sell off shortly after. That is another market maker cycle. And they come in, you can see this is a much longer cycle than the one we looked at right here. But a lot of SPY bottoms end up in this example. You can see right here, technical bottom set, higher volume relative to previous levels. Then all of a sudden you have this big sell-off, liquidation, come back up, you go above that spring high. These are the conditions, oftentimes what you see on indices and how they bottom. It's almost every time. Now I will say the most common bottom, the most common structure you can expect from a bottom is a liquidation. You're not always going to get a spring. But that is why we study this so much and why my research has led me to believe that this is one of the most accurate cycles you can actually do. Again, here's the technical bottom. Here is the higher volume come up spring. You can see the spring lasted a little longer. You sell off. You can see that we went a little deeper than a lot of people were probably anticipating. But this eventually ended up being the liquidation and the move higher, targeting above the spring high. That is exactly, it's rinse and repeat that. Now, with that being said, now that I've shown you a few previous examples, now we can go to present day. And let's see if your eyes have trained you well enough to spot what's going on currently in the markets. Well, going back to our market maker cycle, if we can just envision it in our heads, here's the technical bottom, here's the spring, max pain, then we come up, recovery flag 1, recovery flag 2, break of spring high. If we can envision that in our head, let's break this down. So first of all, starting from left to right, you can see elevated volume and a technical bottom. That tells you that we are at least in the accumulation phase here. Then all of a sudden we have a move up. And then, oh, look at this, right? Now we have a spike. It seems to be lower volume. That is a characteristic of a spring. Lower volume, but also a fake out. Where I decided that this was really a market maker cycle was these two candles here. And we're going to look at my report, again, that I publish every single Sunday to see how I was breaking this down in real time so you can see my thought process in the moment free of hindsight bias. Because it's one thing just to look at previous examples and go, oh, this is how you could have played it. But in the moment, it's harder to identify and make this bet, which I will show you. So right here, you had this drop. This is where I knew it was going to be a market maker cycle. And then all of a sudden, boom, you have a low break, higher volume, and is this a liquidation? Well, it made a new low, Raider. We're not seeing that much buying pressure, but look at this. The PC ratio spiked well above 1.07. We haven't seen that value since Tuesday, March 4th, and we haven't seen that value even since August even, which was the bottom in the market. If you guys remember, August 5th was the bottom. So big PC spikes across the board. We have a spring, and we have a liquidation. Here's your spring. Here's your liquidation, your technical bottom, and now what we can expect based off the market maker cycle is we have this is the recovery flag 1, come up, recovery flag 2 potentially, and then a move higher. So now that you know the anatomy of this structure and each little component and what it means and some of the characteristics with it, as well as the mechanics of it. That puts are the fuel to the fire after the max pain move. The crush of volatility makes market makers support the trend as it moves higher, giving us a really good trade. But how do we actually go and trade this structure? What are the opportunities within it? And how do we make the most money we can when we do identify this? So to be an effective trader throughout this structure, we can take advantage of this in 3 different places. First of all, the accumulation base to the spring offers a very decent bounce majority of the time that's quite predictable. But again, at this point, we don't know if it's a market maker cycle. But in general, the accumulation base to the spring, if it were to be a spring, is going to be a nice bounce trade. Following a potential spring, there is an opportunity to short into max pain. This is often a more difficult trade because you are shorting towards a market bottom, which typically doesn't go that well in majority of cases. However, there is an opportunity here. I'll show you some examples of me shorting from the spring into max pain. But the third kind of position where you can take in this structure, which is probably the most probable and more likely one that often a lot of people just wait for, is the max pain move into recovery flag number 1. Once you see that gap down, once you see that push and crush of volatility, it becomes very easy to play the follow through and actually catch the bigger move to the spring high. Now, what names do you actually go and specifically play? Because it does matter if you want to maximize your gain during this structure. You can't just play anything in a market bottom. We have to be smart about which names we choose because that will maximize our profits. If you guys don't already know, what I talk about a lot is the leaders and laggers in the market and how identifying which ones are trend leaders and laggers will maximize your profit throughout the different moves. So first of all, what is a trend lagger and leader? A leader is something that is outperforming the overall markets or other sectors, and a lagger is something that is underperforming. We'll get to examples here in a minute. But right here, during the accumulation base, again, we're not going to know this is a market maker cycle yet, but oftentimes the easiest trade is just to play the bounce in the laggers. This is often a straightforward trade. I have some examples in semiconductors. Oftentimes these names will be technology because technology gets sold off the hardest and often becomes laggers very quickly. Following the spring, there often is no trade within this. It's often just a waiting period or holding longs that you had from the laggers. However, to play any potential drop from the spring into max pain, what you want to play are the weaker leaders. The names that did not sell off the most, that are kind of holding, doing kind of nothing, consolidating, but not the laggers. You want to continue to short the names that did not hold up the best, but they're not also the most beaten down because those are going to get the juicier sell-offs. So I call these weaker leaders. The names that are in the middle of the pack or leading the market, those will get the actual liquidation move because what happens is when they don't get a bigger sell-off here, once you start to get people positioning in and buying, now that you start to sell off again, there's absolutely no hope for those names, and they get often the harshest sell-off in liquidation. Following that max pain move, again, you want to play the laggers out of that to get the initial bounce, and then into recovery flag 1, recovery flag 2, and beyond, where you eventually get the break of the spring high, you want to play purely the trend leaders. The names that either rallied the hardest off the low and have been holding, or the names that entirely just did not sell off as much as the overall market did or other sectors did throughout this drop into max pain. Those are going to be your bigger winners here. And again, for those unfamiliar, the reason we look for trend leaders and laggers, specifically the sectors and industries in the market, is because we want to take advantage of the rotations, that we know that in a market bottom, the first to bounce are always going to be the laggers, always. The ones that get the longest trend push are going to be the leaders from that bottom, the names that outperformed out of that bottom and held the best from the prior trend low. Doing this will maximize our gains, unlike what I see a lot of retail traders do, which is just going and trading their favorite stock or the one they like to trade the most. That doesn't guarantee you the biggest profit. Remember, if we see a market bottom, our job as traders is to go find what's going to move most from that bottom so that we can hit home run trades. All right, and to put this all together, we can actually look at the current example on SPY and see how I've played it so far and what my future predictions for the market actually are. So let's start first with the first phase of the market maker cycle, which is the accumulation base or the technical bottom that we were referring to. The technical bottom really started from the 10th all the way up to the 14th. So this general time frame was what we were looking for to see an initial bottom in. How did I position for that? What was I looking for? Well, you can actually see it on the RADER Report. I publish these every single Sunday before the week starts. My trade ideas, my professional thesis, and data that I'm walking into this week. And what our game plan was for this specific week, the week of March 9th, was that I was looking for some sort of technical bottom. I was looking for that initial bounce. We had already seen some slight volume increases, but I wanted to see some sort of, big liquidation or final little point of pain to start this kind of bigger slowing down period and ultimately a bounce. And so we took in to account OPEX cycles, which I talk about a lot, but also we looked at the PC ratio and determined that the 560 level, the 560 put wall level would be the liquidation level for the markets. That if we got down to 560 level, not max pain, let me be clear, just on a smaller time frame, we wanted to see the selling climax and then start that technical bottom period where we can expect more strength in the market. So going back to how we kind of talked about what to trade when it comes to the different names, laggers or leaders, this says to play the laggers off of that initial accumulation bounce. So the better trade was to actually play the laggers off of that. So my entire report, I went and I found the laggers and the names that I thought would be the best recovery trade. And one of them, of course, is semiconductors, NVIDIA, AVGO, these guys. There was a big liquidity attraction all the way up to 123 by 321. But also, this was the most beaten down name. It had sold off the hardest from the low, and it also was weaker relative to the overall markets because it additionally made another low, even though the overall markets were struggling to do so. So right here, we determined, okay, NVIDIA is a buy, anything under 105.06, and then you would see some sort of bounce up into 104.14. Again, to maximize our gains, we're not just going to go play anything. We're going to go play the names that sold off the most because that's how we make the most money on the rebound. And when we see a perfect ball, pitched right down the middle, we can swing hard and actually get it. So almost to the level, NVIDIA liquidated right here on the 11th. And you can see from the low here, NVIDIA bounced all the way up 15.5% from the low. The options didn't, they went up around 150%. However, SPY, what did SPY do during that? Well, I can tell you it did not do 15%. It only did 4.6%. So this is how, whether you trade equity, options, whatever, this is how you maximize your gains, is you find the leaders and laggers and you're able to capitalize off of them and maximize your swing when you do see a market pivot coming. Okay, so the next step of this is going to be the spring, right? And so the spring right here, it's a little hard to identify. We're going to have to do some waiting and maybe even holding positions until we start to see that slow down. But ultimately, when you see that drop here, boom, into this area, that's where you can tell when the max pain is coming. Now, how did I position for that? Well, that was actually this week's report. So this week's report, I talked a lot about how liquidity was pointing towards, that there was going to be some sort of max pain coming in the markets. And you can see right here, this was the specific page that I was looking for. And this right here was where we talked about that you're not really going to identify whether it's a spring until you start to see that drop back towards the low here. So when I saw this, I was like, okay, this is the characteristics of a spring or a market maker cycle. When you have elevated volume into this technical bottom, great, we played that. We played NVIDIA, we played the other names. We got the laggers, we capitalized on that. Now the stage 2 of this trade is any shorts down, right? You could have shorted from here to here, even this candle. I did short LLY. The weaker leaders, remember, the weaker leaders with less structure, that name was LLY. So this was a leader from the bottom. It had bottomed, quite significantly, and it was just still a weaker leader is what I call it. You short it back, and you can see LLY was a nice consistent short here. That was the only name I shorted, though. But in general, you're better off waiting for the liquidation. So in this case, we're like, okay, we're 2 candles in. We have a lot of momentum towards the low. The odds of us going to break that low are very significant. But there's a lot of data to support that this is going to be the liquidation. Remember, we don't want to just look at the markets from a chart perspective. We need to truly understand, is this a market maker cycle? And so there was a lot of data pointing towards that. There's this VIX call order, which if you've seen previous videos of mine, you know what this has an effect on the market. Basically, this VIX call order is a symptom or a sign that the markets aren't actually going to drop that much into April 2nd, which is Liberation Day, which is today of me filming this. And you can expect potentially a volatility crush after and ultimately a bigger rally like we're anticipating. And there's a lot of factors supporting which level that would be and also the timing of it. Again, we have April 2nd, which is a big pre-planned event for Trump, right? Trump is expected to announce today, April 2nd, 2025, the tariffs. And there's been a lot of hype around this. If he does announce tariffs and it comes out worse or less worse than expected, or just like everyone expected, then you likely will see a dramatic volatility crush. Remember what we said about volatility crush, that fuels the rally higher as puts lose value, creating a trend that's supported by market makers. And that's why we call it a market maker cycle. So right here, this was, again, we looked at a negative gamma levels, and I said, you know what? It looks like 550 or 555 is a great level for the markets to reach that bottom. And it turned out to be 550. So we're looking for that new low, negative gamma, offering support to the market, a really big level that we're looking at. So overall, in this stage, what were we going to go trade? Well, the max pain trade from this to this, we want to trade the laggers first and then trade the continuation of the leader. So to do this, I went and I traded basically anything with a hedge flow put order on it. This meets certain criteria. It's option orders I look for. And my positioning was this week positioned for the buy the dip opportunity while the downside is still possible. Data suggests the dip buy opportunity for the most favorable ones off of that liquidation is best. And basically, I was looking for anything with hedge flows on it, hedge flows on them to add derivative support. I'm looking to find those orders, those individual stocks within the sectors that are lagging that have the greatest kind of potential to move off of any liquidation that does happen in the market. And one of them that had a beautiful hedge flow order on it was Hood. This was actually one of my favorite trades of the week. And this had a major imbalance, tons of puts in the money, but also this big fresh put order came in. And I said, look, any drop down below this 40, then back up to it, that's where I'm going to take a long. This is a lagging name. It got beaten down more than a lot of other stocks during that max pain move down. You went all the way from 50 all the way down to 39 almost. A huge drop, well over 22% on that liquidation. And what do we say? Well, if you want to catch the the big move in the laggers, off of that liquidation, those are going to be the names that move more. So I caught the move off of Hood, well over 100%. Nice trade. You got 11.94% move in Hood. I'm still going to hold some exposure. So what is my game plan moving forward? Well, I talked a little bit about it on Twitter. This was a post I made. This is the chart that we're actually looking at right now. So this is currently what it is. I did a little more detailed analysis of the market maker cycle, and you can see max pain. We expect a recovery flag, and that's exactly what we're getting right now. You can see the recovery flag. And then you should expect potentially a gap down in Trump if it comes out way worse than expected. Again, it is dependent on the news, but the odds tell us that we will likely see maybe a small gap down and then a pump up, or we just altogether go higher from here. But I think the more likely scenario is you see a slight gap down or something of that sorts and then a move higher. But again, theoretically, we should not break the low of, if this is truly max pain at 548, then that would be the absolute low. And the names to play are going to be the laggers out of it, or anything with big hedge flows that we can actually expect a bigger reversal from. So one of those names is actually PFE. PFE had this massive hedge flow order, and this is going to be a lagger. It sold off harder than the overall markets did from the high, and not from the high of here, but from here to here. And so that can be a big indication that, okay, well, we also have flow to suggest why this would go up. So PFE is a buy the dip trade. We want to rotate into this, probably into or after the Trump announcement, get a big move back to 25.5. That's where the hedge flow order was. So again, write this down, come back and critique me if I'm wrong, but I'm going to be trading this. PFE long side to 25.5. By next week, I think this is going to be a resilient trade. That is, again, a lagger, a name that was beaten down more than the overall markets. So I'm going to trade this to the upside. Now, after the Trump announcement, once we maybe gap down or something like that and then start to rally again, now that the bottom is actually set, if the Trump news comes out and we start to actually do rally, or we do start to hold the levels, what is the next trade? The next trade is ENPH. These are the leaders, the names that did not sell off as hard. So ENPH is going to be that great continuation trade towards and through the high, following us actually gapping down, maybe rallying back and starting to recover. So this is going to be the continuation trade, the names that held the most. And you can see it hasn't bottomed since, or it hasn't broken the low since March 4th, while the overall markets did, making this an obvious leader. What is another way you could actually identify leaders? Well, I actually, on my platform, the RADER Report, can use this tool to have a custom time frame. And you can say, okay, well, RADER, I want to find, what were the laggers coming into the technical bottom that we had for SPY. And, if you go back to SPY and you say, okay, well, I want to trade the accumulation phase of this to catch that bounce potentially into a spring, then we would play what? We would play the laggers here. So we're going to find the most beaten down names from the 21st all the way down to this, because it hasn't rallied yet, to find which names are going to bounce the most. And if you use this tool here, You can do the sectors, you can do the industries, but right here, if we click the industries, you'll see the most beaten down names are what? They're airlines, they're clean energy, they're the semiconductors, and all of these names were the names on the report that I was searching for. So I went and I scanned each one, and I found the best trades, thus being NVIDIA, which was ultimately the number one trade of the week for me. But that's how you go and find these. So overall, my next predictions for the market are that we're likely to see more upside in the market, and that following the Trump event, I believe there will be some sort of gap down or slight weakness, but ultimately a crush of volatility. Now, there is a chance that potentially you see a bigger gap down in the market. The expected range right now is around $9 up or down. So long as we stay $9 up or down within the expected range, so that would be about, give or take about $5.50 or somewhere like this. If this is where we can stay above, then I expect that we will still see that volatility crush. However, if this does gap down all the way to $5.35, then the idea is for the most part out of the picture. However, it isn't entirely out because sometimes the liquidations can be harder to time. Sometimes the liquidations go much deeper than we anticipate, and we're just going to have to bite the bullet on some of these things and reassess as the information changes in front of us. But as of now, the odds tell us that this was the liquidation, that we are in this market maker cycle, and that we can expect at least a break of spring high through April 11th to the ultimate upside target. So hopefully today you learned a lot about the power of a market maker cycle. That, it's not just some pattern we look for or shape, that it's actually a mechanical process that we look for to capitalize off of. That market makers buying back puts after a max pain move supports trend and thus gives us a pretty high edge trade to the upside. And also the structure itself is pretty predictable and offers opportunities throughout it. Hopefully as well, you learn how to actually trade it. Into the initial accumulation base, you trade the laggers, then you short the weaker leaders, such as LOY as I showed you, and then you move to trade the laggers once more, the names that were most beaten down from that liquidation, like semiconductors, like these other names, and then ultimately play the leaders for that bigger trend continuation that's supported by the market makers like ENPH or solar stocks. As I'm filming this, April 2nd, we have no idea what Trump is going to say or what he's going to do. But what I can tell you is that I'm going to be prepared and I'm going to write about it in the report of how I'm positioning. If you guys want to stay up to date with my trades, entries, and everything like that, live data tools, everything, I promise that this platform is for you. I've put my blood, sweat, and tears into this. I've had exceptional mentors throughout my life. I'm very lucky to know what I do at my age, but I am trying to change an industry of research and market opinion that has been diluted with a lot of nonsense. This industry is filled with people who are scared to give their opinions because they don't have substantial data to back them. So more often than not, when you pay for these expensive research pieces that are upwards of $300-400 a month, all you get is it could go up, it could go down. But no one's showing you what is the better odd trade, what is the positioning of the market, and where can we as traders benefit from these opportunities. The goal of the RADER report is to be specific, more specific than any other research out there. After all, it is directly my trading game plan that I just publicized. I was writing these for myself way before I actually launched the RADER report. Other than that, guys, thank you so much for your attention today. Please go out and find some examples of this, send it to me on X, and let me know because I will always give you guys my thoughts, critiques, and ways to improve. Have a nice day, guys. Bye-bye.